There is a single question that, if you learn to ask it correctly, will protect you from more financial ruin and guide you toward more legitimate wealth than any other. It is a question that cuts through the noise of cable news, the breathless predictions of market analysts, and the seductive complexity of spreadsheets. It is a question that Warren Buffett has made the cornerstone of a fortune that defies comprehension. The question is this: is the person running this company in love with the business, or are they in love with the stock? The answer is the final promise that separates fleeting gains from generational wealth. It's the hidden key to unlocking true, sustainable portfolio growth, the kind that leads to unassailable financial freedom. Most investors, even seasoned professionals, get this wrong. They fall for the charismatic CEO, the one who speaks the language of Wall Street, who knows exactly how to manage quarterly expectations and paint a rosy picture for the next 90 days. They invest in financial engineers, masters of perception, who are brilliant at making the stock go up in the short term, often while the underlying business slowly, quietly rots from within. This is the great trap of modern investing. It's a siren song that has lured countless portfolios onto the rocks. But you are here because you suspect there is a better way. You understand that behind every stock ticker is a real, living, breathing business made up of people, products, and customers. And the quality of that business, its ability to endure and to grow its earning power over decades, is determined by the character and focus of its leadership. Today, we will dissect the Buffett philosophy on management. We will move beyond the simple platitudes and build a rigorous, actionable framework for identifying the leaders who build real value, the operators who are obsessed with their craft, not their, quote, screen. This is not about a hot stock tip. It is about acquiring a mental model, a new way of seeing that will transform you from a speculator into a true business analyst. You will learn to spot the difference between the performer and the builder, the promoter and the proprietor. By the end of our journey today, you will possess a checklist, a powerful diagnostic tool that will allow you to evaluate the most critical, yet most overlooked aspect of any investment: the mind and motivation of the person at the helm. This is the secret to moving beyond the crowd, to aligning your capital with the forces of genuine value creation, and to building a portfolio that doesn't just survive the whims of the market, but thrives because it is anchored to businesses of exceptional quality, run by leaders of exceptional character. The first and most fundamental pillar in understanding this critical distinction is what we will call the operator's obsession versus the stock ticker's siren song. It's the difference between a passion that is forged in the factory and a passion that is forged on the trading floor. One is about creating value, the other is about creating perception. And no story illustrates this more powerfully than Warren Buffett's encounter with a tiny, indomitable Russian immigrant who built a commercial empire in the heart of Omaha, Nebraska, on a foundation of pure, unadulterated passion for her business. Her name was Rose Blumkin, but everyone knew her as Mrs. B. In 1937, with a mere $500 borrowed from her brother, she opened the Nebraska Furniture Mart in the basement of her husband's pawn shop. She couldn't read or write English, but she understood one thing better than anyone else: value. Her business philosophy was brutally simple and ruthlessly effective. Sell cheap and tell the truth. She was a force of nature, a selling machine who worked 7 days a week, from open to close, well into her 90s. She didn't have an MBA. She didn't have a stock ticker in her office. What she had was an all-consuming obsession with her business: the furniture, the customers, the process of buying at the absolute lowest price and passing those savings on. Her competitors, the established, sophisticated furniture stores downtown, hated her. They colluded with suppliers to try and cut off her inventory. They took her to court for violating fair trade laws because her prices were simply too low. In court, the judge asked her if she understood the law she was accused of breaking. She replied through an interpreter that she did not, but she invited the judge to come to her store, where she would happily sell him a carpet for $3 a yard less than any of her accusers. The judge dismissed the case. This was the legend that reached Warren Buffett's ears. By the early 1980s, the Nebraska Furniture Mart was doing over $100 million a year in sales, and was the single largest home furnishing store in the entire country, all located on one 75-acre campus in Omaha. Buffett, whose office was just a few miles away, knew he had to meet this woman. He went to the store and was astounded. He saw a business that generated incredible profits with almost no debt, fueled by the sheer force of its founder's will. In 1983, Buffett approached Mrs. B, then a vibrant 89 years old, about buying the company. The negotiation, if you can call it that, was legendary. There were no investment bankers, no teams of lawyers conducting months of due diligence. Buffett asked her how much she wanted. She named a price. He asked if she would have any audited financials for him to review. She replied, "Mr. Buffett, we don't have audited financials, we have my word." She looked him in the eye and said, "If I tell you something is so, it's so. If you don't believe me, we don't have a deal." Buffett instantly knew he was dealing with an operator, not a deal maker. He agreed to buy 90% of the company for approximately $60 million. The contract was a page and a quarter long, written by Buffett himself. He didn't check her inventory, he didn't audit her books. He wrote the check on the spot. Why? Because he wasn't buying a collection of assets, he was buying a culture. He was partnering with a leader whose entire identity was interwoven with the success of her business and the satisfaction of her customers. She wasn't thinking about earnings per share or managing analyst expectations. She was thinking about how to get a better deal on a shipment of sofas from North Carolina. She was thinking about the family from Council Bluffs who needed a new dining room set. Her obsession was with the tangible reality of her business. That is the operator's obsession. It is pure, it is powerful, and it is the ultimate source of a company's durable competitive advantage. This profound difference in focus between a leader like Mrs. B and a typical modern CEO is rooted in a deep psychological principle, the battle between intrinsic and extrinsic motivation. Intrinsic motivation is the drive to do something because it is inherently interesting, challenging, or satisfying. It's the artist who paints for the love of creating, the scientist who explores for the joy of discovery, the entrepreneur who builds a business because they are passionate about solving a particular problem. Mrs. B was intrinsically motivated. Her reward was the thrill of the sale, the satisfaction of outsmarting her competitors, and the pride of building a business that served its community. Her wealth was a byproduct of her passion, not its goal. Extrinsic motivation, on the other hand, is the drive to do something because of an external reward, or to avoid an external punishment. This is the realm of bonuses, stock options, promotions, and the fear of being fired. The modern corporate world is almost entirely structured around extrinsic motivation. A CEO's compensation is often tied directly to the company's stock price performance over a relatively short period. They are celebrated on financial news networks when the stock is up and vilified when it is down. Their entire world revolves around this external validation. This creates a dangerous psychological trap known as the over-justification effect. Studies have shown that when you take an activity someone is intrinsically motivated to do, say a child who loves to draw, and you start paying them for every drawing they produce, their intrinsic motivation plummets. The activity is no longer about the joy of creation. It becomes a task performed for a reward. When the reward is removed, the person often stops the activity altogether. The love of the game has been replaced by the love of the prize. The financial engineer CEO is a victim of the over-justification effect on a corporate scale. They may have started their career with a genuine passion for their industry, but the relentless pressure of the quarterly earnings game and the massive financial rewards tied to stock performance have shifted their focus. Their job is no longer to build the best business. It's to produce the best numbers for Wall Street. This leads to a cascade of value-destroying behaviors. They'll cut corners on customer service to save a few pennies in the short term. They'll slash research and development budgets, the seed corn of future growth, to make the current quarter's profits look better. They'll engage in complex financial engineering, using debt to buy back shares at inflated prices to artificially boost earnings per share. These actions are all extrinsically motivated. They are designed to manage the stock price, not to enhance the long-term health and earning power of the underlying business. The intrinsically motivated operator, however, thinks in decades. They see spending on customer service and R&D not as expenses, but as crucial investments in the company's future. They are willing to sacrifice short-term profits for long-term dominance. They are playing a completely different game, a game that the extrinsically motivated CEO, tethered to the 90-day shot clock of Wall Street, is psychologically incapable of winning. Your job as an investor is to find the leaders who still love to draw, even when no one is paying them for the picture. So how do you, as an individual investor, translate this psychological understanding into a practical tool for stock analysis? How do you pierce the corporate veil and diagnose a CEO's true motivation? The answer lies in reviving a classic but often forgotten technique that Buffett champions, the scuttlebutt method for management analysis. It's about digging beyond the glossy annual reports and carefully scripted conference calls to find the raw, unfiltered truth. This is your blueprint. First, become an anthropologist of corporate language. Listen to quarterly earnings calls, but ignore the numbers for a moment. Focus on the words, the tone, and the subjects the CEO gets most excited about. Does their voice light up when they talk about a new product feature, a factory improvement, or a particularly happy customer? Or do they come alive when they're discussing financial metrics, using jargon like synergies, optimization, and multiple expansion? The operator speaks the language of the business. They'll tell stories. They'll use simple, direct language. The financial engineer speaks the language of Wall Street. They will sound like a finance textbook, hiding behind complexity and abstractions. Create a checklist. For every 10 minutes of an earnings call, how many minutes are spent on operational details versus financial engineering? How many times are customers mentioned versus analysts? The ratio will be incredibly revealing. Second, read the CEO's annual letter to shareholders as if it were a personal letter to you. Buffett considers this letter the single most important document a company produces. Is it written in clear, plain English, or is it a swamp of legalese and buzzwords? Does the CEO openly and honestly discuss the company's mistakes and what they learned from them? Or does every challenge get spun into a future opportunity? A leader who admits error is a leader who is secure in their long-term vision. A leader who blames external factors for every setback is a leader focused on managing perception. The best letters, like Buffett's, teach you something about the business and the industry. The worst ones are pure public relations, designed to obscure rather than clarify. Third, go beyond the company's official pronouncements. Use resources like Glassdoor to read reviews from current and former employees. Is the CEO respected as a business leader, or are they seen as a remote figure obsessed with numbers? Employees have a ground-level view of where management's priorities truly lie. Are the internal company values focused on product excellence and customer service, or is there a high-pressure sales culture focused on hitting arbitrary targets? And finally, study the CEO's history. Where did they come from? Did they rise through the operational ranks of the company, demonstrating a deep understanding of the nuts and bolts of the business? Or were they brought in from a finance background, a consultant, or an investment banker with a mandate to, quote, create shareholder value, which is often code for financial maneuvering? By applying this scuttlebutt blueprint, you move from being a passive consumer of information to an active investigator. You learn to read the subtle signals that reveal a leader's true obsession, allowing you to partner with the builders, not the promoters. To truly appreciate the wisdom of backing the operator, we must dedicate some time to studying its antithesis, the path of the 99%. This is the well-trodden road of investing in charismatic financial engineers who promise the world and deliver ruin. It is the path most investors take because it is seductive and exciting, and its most infamous practitioner was a man they called Chainsaw Al. Albert J. Dunlap was the rockstar CEO of the 1990s. He built a legendary reputation as a ruthless corporate turnaround artist. His playbook was simple and brutal. He would take over a struggling company, fire thousands of employees, close factories, and sell off assets. He was the personification of a leader obsessed with the stock price. He cared nothing for the business, the employees, or the customers. His only goal was to slash costs to the bone, generate a short-term pop in profits, and send the stock soaring. Wall Street adored him. Analysts praised his decisiveness. His face graced the covers of magazines. He wrote a best-selling book titled Mean Business. In 1996, he was brought in to save the struggling appliance company Sunbeam. The market erupted with joy. Sunbeam's stock shot up 50% on the day of the announcement. Investors, the 99%, piled in, thrilled to be along for the ride with the legendary Chainsaw Al. He immediately began his standard routine. He fired half of the company's 12,000 employees. He closed or sold off 2/3 of its factories. He talked a brilliant game on conference calls, promising a glorious new era for Sunbeam. And for a while, the numbers looked fantastic. The stock more than tripled in under 2 years. But behind the scenes, a cancer was growing. Dunlap's obsession with hitting Wall Street's quarterly targets led to a culture of widespread accounting fraud. To make the numbers, the company engaged in a practice called channel stuffing. They offered massive, unsustainable discounts to retailers to get them to buy huge quantities of products, like barbecue grills in the middle of winter, booking the sales immediately to inflate revenue. They were essentially stealing sales from future quarters to make the present look better. The warehouses were full, the retailers were overstocked, but the quarterly reports looked amazing. Dunlap knew nothing about making better appliances. He knew nothing about building a brand or fostering customer loyalty. He only knew how to manipulate the numbers to please Wall Street. He was the ultimate financial engineer, a master of perception. But reality always, eventually, asserts itself. By 1998, the house of cards collapsed. The market realized the sales were phony, the growth was an illusion, and the company was fundamentally broken. The stock plummeted by more than 90%, wiping out billions of dollars in shareholder value. The company was forced into bankruptcy. Al Dunlap was fired and later barred by the SEC from serving as an officer of a public company. The story of Chainsaw Al is the ultimate cautionary tale. He is the antithesis of Rose Blumkin. He represents the path of the 99%, getting mesmerized by a celebrity CEO who focuses on the stock ticker. Investors who backed him weren't investing in a business. They were making a bet on a single man's ability to trick the market for a little while longer. The costly mistake is believing that a rising stock price is the same thing as a healthy business. It is not. Often, as in the case of Sunbeam, one comes at the direct expense of the other. Avoiding this mistake is the first great step towards superior wealth management. The difference between an operator's obsession and a financial engineer's focus isn't just a philosophical or psychological curiosity. It manifests directly and powerfully on a company's financial statements and in the long-term performance of your investment portfolio. Let's connect these ideas to the numbers, to the tangible metrics that drive capital gains. A company led by an operator, someone like Mrs. B, exhibits a distinct financial signature. Because they are obsessed with customer satisfaction, they build a base of loyal, repeat customers. This translates into a higher customer lifetime value and lower customer acquisition costs. You'll see this in a stable or rising gross margin and a lower percentage of revenue spent on sales and marketing compared to competitors. Because they view their employees as partners in value creation, not as costs to be minimized, they tend to have lower employee turnover. This directly reduces hiring and training expenses, which flows straight to the bottom line as operating profit. Because they are focused on building a durable enterprise for the long term, they make consistent investments in research and development and in maintaining their physical assets, property, plant, and equipment. A financial engineer sees these as easy places to cut to make a quarterly number. The operator sees them as the very foundation of the company's future earning power. This results in a stronger, wider competitive moat that protects the business from competition. The most significant financial connection, however, is in the quality and predictability of the company's cash flows. An operator-led business generates authentic, sustainable free cash flow. A business run by a financial engineer often produces lumpy, artificial profits based on accounting tricks or one-time asset sales. As an investor, your entire return is ultimately derived from the future cash flows of the business you own a piece of. The operator's focus on operational excellence creates a river of predictable, growing cash. The financial engineer's focus on quarterly earnings creates a mirage. Over a 10 or 20-year period, this difference is not trivial, it is everything. A company that can consistently generate and reinvest cash at a high rate of return will compound its intrinsic value at a spectacular pace. Its stock price, over the long run, will inevitably follow its intrinsic value. A company that hollows out its operational core for the sake of short-term stock performance will see its intrinsic value decay, and eventually, its stock price will collapse to reflect that grim reality. By learning to identify the operator, you are learning to identify the businesses that are capable of true, long-term compounding. You are aligning your personal finance goals with management teams that are building real, lasting corporate governance structures. This is the ultimate financial advantage, a way to beat the market not by being smarter, but by being more patient and choosing to partner with leaders who are playing the same long-term game you are. The second great pillar of Buffett's management evaluation system flows directly from the first. Once you have identified a leader with an operator's obsession, you must then determine if they possess the single most important skill for a CEO, the ability to allocate capital intelligently. This is capital allocation as the CEO's true test. A business generates cash. What the CEO chooses to do with that cash is the decision that, over time, determines the fate of your investment. A great operator who is also a great capital allocator is the Holy Grail. A great operator who is a poor capital allocator can run a wonderful business into the ground. And there is no greater master of this craft in Buffett's view than a man named Tom Murphy, the CEO of Capital Cities/ABC. The story of Tom Murphy and his partner Dan Burke is a masterclass in rational, disciplined, shareholder-focused leadership. They took a tiny, struggling television station in Albany, New York in the 1950s and, through a series of shrewd, value-creating decisions, built it into a media empire. Their philosophy was unique. First, they ran a highly decentralized operation. They bought good businesses with good managers and then left them alone to do their jobs. They didn't believe in a bloated corporate headquarters filled with MBAs micromanaging the operations. Second, they were incredibly frugal. Their corporate headquarters was famously Spartan, a testament to their belief that the company's money belonged to the shareholders, not to management. But their true genius was in capital allocation. They viewed the cash their businesses generated not as their own, but as a sacred trust from their shareholders. Their job was to reinvest that cash at the highest possible rate of return. They were constantly evaluating opportunities, comparing the potential returns from reinvesting in their existing businesses against the returns from acquiring new ones. They only made acquisitions when they could buy a high-quality business at a sensible price. Their masterpiece came in 1985. Capital Cities, by then a successful but still second-tier media company, announced it was acquiring the American Broadcasting Company, or ABC. At the time, this was the largest non-oil merger in U.S. history. It was a minnow swallowing a whale. ABC was more than 3 times the size of Capital Cities. The deal was valued at $3.5 billion. Wall Street was stunned. But Murphy and Burke had done their homework. They knew that ABC, while a prestigious brand, was run inefficiently, with bloated costs and a classic big company culture. They saw immense potential to improve its operations and profitability. Buffett was so impressed with Murphy's logic and his track record that he committed $517 million of Berkshire Hathaway's money to help finance the deal, a massive sum for Berkshire at the time. It was a bet on Tom Murphy as a capital allocator. The bet paid off spectacularly. Murphy and Burke applied their lean, decentralized, operator-focused philosophy to ABC. They slashed wasteful spending, empowered local managers, and dramatically improved the company's margins and cash flow. A decade later, in 1995, they sold the combined company Capital Cities/ABC to Disney for $19 billion. The original shareholders of Capital Cities had seen their investment compound at a rate of over 20% per year for decades, a return that dwarfed the general market. Buffett has said that Tom Murphy and Dan Burke were probably the greatest two-person management team that America has ever seen. The lesson here is profound. The CEO's most important job is not public relations or even day-to-day operations. It is deciding where to deploy the company's financial resources to create the most long-term value for shareholders. A leader who excels at this can create an astonishing compounding machine. A leader who fails at it can squander the profits of even the finest business. The psychological forces that prevent most CEOs from becoming brilliant capital allocators like Tom Murphy are powerful and deeply ingrained in human nature. Two of the most significant are the endowment effect and status quo bias. The endowment effect is our tendency to overvalue something simply because we own it. A CEO who has spent their entire career in a particular division of a company will naturally see that division as more important and having better prospects than it might objectively deserve. They are endowed with it, and so they will continue to pour capital into it, even if that capital could earn a much higher return elsewhere. They fall in love with their existing assets, blinding them to more rational alternatives. Status quo bias is our preference for keeping things the way they are. Making a bold acquisition, selling off a long-held but underperforming division, or making a large share buyback are all actions that involve risk and change. It is often easier and safer for the CEO's career to do nothing, to simply continue with the current strategy, even if it's suboptimal. Great capital allocators like Tom Murphy are able to overcome these biases. They possess a kind of emotional detachment from the business's assets. They don't see a beloved legacy division. They see a pool of capital that must justify its existence every single day. They are not afraid of change. They embrace it if it is rational. Buffett describes this mindset perfectly. He and Charlie Munger think of the retained earnings of Berkshire's subsidiaries not as the company's money, but as the shareholders' money. Each year, those earnings are swept to the corporate headquarters in Omaha, and their job is to redeploy that capital where it will be treated best. They're constantly asking, what is the highest and best use of this next dollar? There is no room for sentimentality or ego in this calculation. This mindset is incredibly rare. Most corporate leaders are driven by a desire to build empires. They want to preside over a larger company, not necessarily a more profitable one. They are addicted to the thrill of the deal and the prestige that comes with making big acquisitions. This institutional imperative, as Buffett calls it, leads them to follow the herd, making foolish acquisitions at the peak of the market, simply because their competitors are doing it. The master capital allocator is an iconoclast. They are willing to sit on a mountain of cash for years, waiting for the perfect opportunity, even as Wall Street screams at them to do something. They are willing to sell a business that has been part of the company for generations if it no longer meets their criteria for returns. They are disciplined, rational, and have a laser-like focus on per-share intrinsic value. They have successfully conquered the emotional and psychological biases that lead the vast majority of their peers astray. To assess a CEO's capital allocation skill, you need a framework. You can call it the 5-choice framework. Every dollar of profit a company generates presents its leadership with 5 fundamental choices. Your task as a business analyst is to evaluate the wisdom of their decisions over time. The 5 choices are: 1. Reinvest in the core business. 2. Acquire another business. 3. Pay down debt. 4. Pay a dividend to shareholders. Or 5. Buy back the company's own stock. Let's create a blueprint of questions you can use to grade your CEO. First, for reinvestment in the core business. What is the historical return on invested capital, ROIC, for this business? If the company is earning a high return, say 20% on its capital, then reinvesting profits back into the business is a fantastic choice. If the business earns a low return, like 6%, then reinvesting more capital is like pouring water into a leaky bucket. A smart CEO knows when their business has reached a point of diminishing returns and should stop throwing good money after bad. Second, for acquisitions. Look at the company's acquisition history over the past 5 to 10 years. Did they overpay? A common mistake is to pay a huge premium for a hot company in a trendy industry. Did the promised synergies ever materialize? Often they do not. Was the acquisition integrated successfully, or did it lead to a culture clash and operational chaos? A track record of value-destroying acquisitions is a massive red flag. Third, for paying down debt. Is the company carrying too much debt? A reasonable amount of debt can be efficient, but excessive leverage makes a company fragile and vulnerable to economic downturns. Using cash flow to strengthen the balance sheet can be a very prudent move, especially if the interest rate on the debt is high. A CEO who is quick to take on debt for risky acquisitions but slow to pay it down is not thinking about long-term resilience. Fourth, for paying dividends. Is the business mature and generating more cash than it can intelligently reinvest? If so, returning that cash to shareholders in the form of a dividend is a disciplined and shareholder-friendly decision. It's an admission by management that the shareholders might be able to find a better use for that capital than the company can. A reluctance to pay a dividend in a mature, slow-growing business is often a sign of an empire-building CEO. And finally, the most misunderstood choice: stock buybacks. Are they buying back stock when it is trading at a significant discount to its intrinsic value? If so, this can be an incredibly powerful way to increase the per-share value for the remaining shareholders. However, most companies do the opposite. They buy back massive amounts of stock when times are good and the price is high, often to offset the dilution from executive stock options. Then, when the market crashes and their stock is cheap, they stop buying because they need to conserve cash. This is value-destroying behavior. A great capital allocator buys their own stock with the same value-oriented discipline they would apply to buying any other business. By systematically asking these questions and examining management's historical choices, you can build a scorecard of their capital allocation prowess. This is one of the most vital forms of due diligence for any long-term investor seeking significant portfolio growth. The road to financial disappointment is paved with grand, ego-driven corporate mergers that made perfect sense in the boardroom and proved to be an absolute disaster in the real world. This is the antithesis of wise capital allocation, and no story screams this louder than the catastrophic AOL-Time Warner merger of 2000. This was not just a bad deal, it was arguably the worst deal in corporate history. A textbook example of what happens when empire building, flawed vision, and a complete disregard for operational reality collide at the peak of a market bubble. At the turn of the millennium, AOL was the king of the new economy. It was the gateway to the internet for millions of Americans, the face of the dot-com boom. Its stock price had soared to astronomical levels, giving it a currency with which to buy almost anything. Time Warner was the titan of the old economy, a media behemoth that owned Warner Brothers Studios, HBO, CNN, Time Magazine, and a vast cable network. The idea, as pitched by AOL's Steve Case and Time Warner's Gerald Levin, was to create an unstoppable, vertically integrated media and internet superpower. They would combine AOL's massive online audience with Time Warner's world-class content and distribution network. The buzzword was synergy. It was a marriage of the future and the past, a company that would define the 21st century. The deal was announced in January 2000, with AOL acquiring Time Warner for a staggering $164 billion. The leaders were lauded as visionaries. They were celebrated on magazine covers. They had created the largest company in the world. This was the path of the 99% in its most extreme form. Investors getting swept up in a grand narrative, a story of transformation and inevitable dominance, without asking the hard questions about the underlying business logic. The problem was, the entire premise was a fantasy. The promised synergies never appeared. The cultures of the two companies were wildly different and clashed immediately. AOL was a fast-moving, aggressive tech company, while Time Warner was a slow, decentralized confederation of media fiefdoms. Worse, the deal was struck at the absolute peak of the dot-com bubble. Shortly after the merger closed, the bubble burst. AOL's core business, dial-up internet access, was already becoming obsolete with the rise of broadband. Its advertising revenue collapsed. The foundation of the deal's valuation evaporated almost overnight. The result was a bloodbath for shareholders. The value of the combined company, AOL Time Warner, cratered. Just 2 years after the merger, the company was forced to take a goodwill write-down of nearly $100 billion, one of the largest corporate losses ever recorded. The stock price collapsed by over 90%. Gerald Levin, the architect from the Time Warner side, lost his job. Steve Case was marginalized and eventually resigned. It was a complete and utter humiliation. The AOL Time Warner merger is the ultimate monument to poor capital allocation. It was driven by ego, a desire to be the biggest, and a flawed strategic vision untethered from reality. The leaders were focused on the announcement, the narrative, the deal itself, not on the painstaking work of actually integrating two massive, disparate businesses. For investors, it serves as a brutal lesson. When a CEO starts talking about visionary, transformative mergers that promise endless synergy, your skepticism should be at its highest. True value creation is usually much quieter, more disciplined, and far less dramatic. The direct financial connection between excellent and poor capital allocation is the most powerful force in long-term investing. It is the mathematical engine that drives the wedge between market-beating returns and portfolio stagnation. Let's quantify this. Imagine two companies. Company A, run by an operator/allocator like Tom Murphy, and Company B, run by a financial engineer/empire builder. Both companies start with a book value of $1 billion and generate $200 million in earnings for the year, a 20% return on equity. Now, the critical moment arrives, the capital allocation decision. The CEO of Company A, being a disciplined allocator, identifies opportunities to reinvest that $200 million back into the business at the same high 20% rate of return. The CEO of Company B, seduced by ego and the desire for growth at any cost, uses the $200 million to acquire a mediocre competitor, overpaying in the process. This acquisition only generates a 5% return on the invested capital. Let's see what happens next year. Company A's book value is now $1.2 billion. It earns 20% on that, so its new earnings are $240 million. Company B's book value is also $1.2 billion, but its overall return on equity has been diluted by the poor acquisition. Its blended return drops, let's say, to 15%. Its new earnings are only $180 million. Now, let's project this out over 10 years. If Company A can continue to find opportunities to reinvest its earnings at 20%, its intrinsic value will compound at that rate. That initial $1 billion of book value will grow to over $6 billion. The stock price over time will have no choice but to follow this explosion in underlying value. Company B, which consistently misallocates capital into low-return projects, will see its growth stagnate. Its book value might grow, but the rate of return on that capital will steadily decline. After 10 years, its book value might only be $2.5 billion, and the market will likely punish it with a low valuation multiple due to its demonstrated inability to create value. This is not a hypothetical exercise. This is the story of the stock market. The greatest long-term winners, the companies that create life-changing wealth for their shareholders, are almost always a combination of a great business and a great capital allocator. The destructive power of poor capital allocation acts like a reverse compound interest, a constant tax on shareholder value. By learning to analyze a CEO's capital allocation record, you are identifying the companies that have a built-in tailwind for long-term portfolio growth. You are betting on the jockey as much as the horse, ensuring your path to significant capital gains is paved with rational, value-creating decisions from the top. This is the core of sophisticated business analysis and a cornerstone of any successful long-term investing strategy. The third pillar, supporting the entire framework of executive evaluation, is what we will call the cult of candor. It's the radical idea that a CEO should communicate with shareholders with absolute, unvarnished honesty. A business-focused leader sees their shareholders not as a faceless mob to be managed, but as partners in a long-term enterprise. They believe these partners deserve the truth, the good, the bad, and the ugly. There is no greater practitioner of this cult of candor than Warren Buffett himself, and his annual letters to the shareholders of Berkshire Hathaway are the sacred texts of this philosophy. For over 50 years, these letters have been a masterclass in clear thinking and transparent communication. Buffett doesn't use them as a public relations tool to spin the company's performance. He uses them as a vehicle to educate his partners, to explain his thought process, and to hold himself accountable. The most remarkable feature of these letters is Buffett's eagerness to discuss his mistakes. He doesn't bury them in footnotes or obscure them with jargon. He puts them front and center. One of his most famous examples is the story of Dexter Shoe Company. In 1993, Berkshire Hathaway acquired Dexter Shoe for $433 million, paid for not with cash but with Berkshire stock. At the time, Dexter appeared to be a durable business with a strong brand. But shortly after the acquisition, its competitive advantage evaporated due to a flood of cheap foreign imports. The business, which Buffett thought had a durable moat, was worthless within a few years. In his 2007 letter, more than a decade later, Buffett didn't just mention this as a minor error. He dissected it as a colossal blunder, calling it the worst deal that I've made. But he didn't stop there. He went on to explain the true magnitude of the disaster. The Berkshire stock he had used to buy Dexter would, by 2007, have been worth over $3.5 billion. He had traded a phenomenal asset, Berkshire shares, for a business that went to zero. He wrote, "I'll make more mistakes in the future, you can bet on that, but I will not make a mistake of that magnitude." This level of honesty is unheard of in the corporate world. Most CEOs are allergic to admitting fault. They live in a world of perpetual positive spin. But Buffett understands a crucial principle. Candor builds trust. When a leader tells you about their failures, with the same clarity as their successes, you believe everything they say. You know you're getting the straight story. You feel like a true partner. He also uses his letters to explain complex financial and business concepts in language anyone can understand. He demystifies things like derivatives, accounting goodwill, and insurance float. He is not trying to sound smart, he is trying to genuinely communicate. This commitment to clarity is a hallmark of a leader who is deeply confident in their business and respectful of their investors. They have nothing to hide, so they have no need for the smoke and mirrors of corporate jargon. The cult of candor is a powerful filter. Leaders who practice it are revealing something profound about their character and their focus. They are demonstrating that their primary allegiance is to the long-term health of the business and their partnership with its owners, not to the short-term management of their stock price. The psychological chasm between a leader who embraces candor and one who avoids it can be explained by the Dunning-Kruger effect and the use of jargon as a psychological cloak. The Dunning-Kruger effect is a cognitive bias in which people with low ability in a particular area tend to overestimate their competence. Put simply, they are too incompetent to recognize their own incompetence. This often manifests in the business world with leaders who don't have a deep, granular understanding of their own operations. Because their knowledge is superficial, they are unable to explain the business in simple, clear terms. Instead, they retreat behind a wall of corporate jargon, buzzwords, and acronyms. Phrases like leveraging our synergistic platforms to optimize core competencies are not signs of intelligence. They are signs of insecurity. Jargon is a cloak used to hide a lack of understanding. A CEO who throws around complex terms is often trying to intimidate their audience, to create an aura of expertise that they don't actually possess. They are signaling, "This is very complicated, you wouldn't understand it, just trust me." This is a defensive mechanism. A truly brilliant leader, someone with a profound mastery of their subject, does the opposite. Think of the greatest scientists, like Richard Feynman, who could explain quantum physics with stunning simplicity. Or think of Buffett, who can explain the esoteric world of reinsurance in a way that feels like common sense. The ability to simplify is a hallmark of true expertise. When a leader communicates with candor and clarity, they are signaling immense confidence. They are saying, "I understand this business so well from the ground up that I can explain it to you in a way that you will understand. I want you to understand it because you are my partner." This builds a powerful bond of trust. Conversely, a leader who relies on obfuscation and complexity is sending a very different signal. They are creating distance between themselves and their shareholders. They are treating their investors as an audience to be managed, not as partners to be informed. This psychological dynamic is a critical tell. When you encounter a leader who cannot or will not speak in plain English, you should be highly suspicious. It is often a sign that they either don't truly understand the business themselves, or they understand it all too well and are actively trying to hide something. Embracing candor requires intellectual honesty and humility. The leader must be willing to admit they don't have all the answers and that they will make mistakes. The financial engineer, whose entire persona is built on projecting an image of infallible genius to keep the stock price elevated, is psychologically incapable of this kind of vulnerability. Your goal is to find the leaders who have the courage to be clear and the humility to be honest. To turn this principle into a weapon for your investment research, you need a practical guide, an instruction manual for seeing through corporate spin. We'll call this the annual report litmus test. Most investors never read annual reports, seeing them as dense, boring legal documents. This is a huge mistake. The annual report, particularly the CEO's letter at the beginning, is a direct window into the mind of management. Here is your step-by-step blueprint for conducting the test. Step 1. Start with the CEO's letter to shareholders. Read it before you look at any of the numbers. Read it for tone and content. Is it written like a marketing brochure, full of exclamation points and glossy photos? Or is it a sober, business-like assessment of the prior year? A great letter will feel like a conversation. It will treat you like an intelligent co-owner of the business. Pay special attention to how failures and challenges are discussed. Does the CEO take direct personal responsibility? Or is the blame cast on the economy, the competition, or a challenging macro environment? A leader who owns their mistakes is a leader you can trust. Step 2. Conduct a jargon hunt. Scan the entire report, not just the letter, for corporate buzzwords. Create a list: synergy, right-sizing, optimization, paradigm shift, value added, key performance indicators. The higher the density of this meaningless jargon, the higher the probability that management is trying to obscure reality rather than illuminate it. Clear writing is a proxy for clear thinking. Muddled, jargon-filled writing often indicates muddled, unfocused management. Step 3. Play the promise versus performance game. Pull up last year's annual report. Go to the CEO's letter and identify the key goals and promises that were made for the upcoming year. Now, look at the current year's report. Did they do what they said they would do? Did they achieve the goals they set out? Or has the narrative conveniently shifted, with last year's promises quietly forgotten? This exercise is incredibly powerful. It allows you to build a multi-year track record of management's credibility. A management team that consistently delivers on its stated plans is a team you can rely on. A team that is constantly changing the goalposts is likely improvising, not executing a long-term strategy. Step 4. Examine the presentation of financial data. Does the company highlight standard, generally accepted accounting principles, GAAP, earnings? Or do they try to draw your attention to a host of custom, pro forma adjusted earnings numbers? While some adjustments can be legitimate, an excessive focus on non-GAAP metrics is often a red flag that management is trying to paint a rosier picture than reality warrants. The more they have to adjust the official numbers, the more you should question the quality of the underlying earnings. By running every potential investment through this annual report litmus test, you arm yourself against the propaganda and public relations that dominate corporate communications. You learn to judge a management team not on their promises, but on their performance, their clarity, and their honesty. The path of the 99% is to be seduced by complexity and to trust in leaders who project an aura of impenetrable genius. The ultimate, tragic destination of this path was the implosion of Enron in 2001, a scandal that became synonymous with corporate fraud and the absolute antithesis of candor. Enron was, for a time, one of the most admired companies in America. Its leaders, Kenneth Lay and Jeffrey Skilling, were hailed as brilliant visionaries who were reinventing the energy industry. They didn't just sell natural gas, they created complex financial markets for everything from weather derivatives to broadband internet capacity. They were the architects of a new economy, and their stock price soared. Investors who piled into Enron were not investing in a business they understood. They were investing in a story of innovation and complexity, a story told by leaders who were masters of obfuscation. Enron's financial reports were a nightmare of incomprehensible complexity. The company was famous for its use of special purpose entities, SPEs, off-balance sheet partnerships that were used to hide massive amounts of debt and inflate earnings. Even the most sophisticated Wall Street analysts admitted they couldn't fully understand Enron's accounting. This was not an accident, it was a strategy. The complexity was a deliberate smokescreen, designed to prevent anyone from getting a clear picture of the company's true financial health. Their quarterly conference calls were legendary for their arrogance and hostility. Jeffrey Skilling in particular was known for his contempt for anyone who dared to ask a challenging question. In a famous exchange when a hedge fund analyst questioned why Enron wasn't producing a balance sheet along with its earnings statement, Skilling publicly called him an asshole. This wasn't just rudeness, it was an intimidation tactic. The message was clear: we are smarter than you, don't question us. This is the polar opposite of Buffett's partnership model. Enron's leadership treated its shareholders and analysts as adversaries to be outsmarted and bullied. They used jargon, complexity, and aggression as weapons to maintain their illusion. The entire culture was built on a foundation of deception. The truth, of course, was that Enron was a house of cards. The spectacular earnings were a complete fabrication, the product of fraudulent accounting. The business was a sham. When the truth finally came out, the company collapsed into bankruptcy almost overnight, wiping out $74 billion in shareholder value and vaporizing the life savings of thousands of its own employees, whose retirement plans were stuffed with worthless Enron stock. Enron is the ultimate cautionary tale about the dangers of abandoning the principle of candor. It teaches us that complexity is often the friend of the charlatan and the enemy of the investor. When a management team cannot or will not explain their business in simple terms, the problem is not with your intelligence, it is with their integrity. Your demand for clarity is not a sign of naivete. It is your single greatest defense against fraud. The principle of candor has a direct and quantifiable impact on a company's financial performance and its long-term value. This isn't just about feeling good about the people you're invested with. It's about a tangible financial advantage. First and foremost, trust translates directly into a lower cost of capital and what can be called a loyalty premium on the stock price. When a company has a long-established history of transparent and honest communication, it builds a dedicated base of long-term shareholders. These investors understand the business, they trust the management, and they are far less likely to sell their shares during a temporary business downturn or a general market panic. This creates a stable shareholder base, which is an enormous competitive advantage. It allows management to make sound, long-term investments without the paralyzing fear that a single missed quarterly earnings estimate will cause their stock price to collapse. This long-term perspective is essential for building a truly great business. A company run by a financial engineer who has a volatile shareholder base of short-term traders is a slave to quarterly expectations and can never make the bold, multi-year investments required to build a durable moat. Furthermore, this trust and transparency can lead to a higher valuation multiple over time. The market hates uncertainty. Companies that are complex and opaque are often punished with a lower price-to-earnings ratio, as investors demand a higher return to compensate for the risk of being misled. Companies that are clear, simple, and honest, like Berkshire Hathaway, are often rewarded with a premium valuation. Investors are willing to pay a little more for quality and integrity because it reduces the perceived risk. Finally, a culture of candor that starts at the top tends to permeate the entire organization. It creates an environment where problems are identified and solved quickly, rather than being hidden for fear of punishment. This operational honesty leads to greater efficiency, fewer costly mistakes, and better products and services. It is the foundation of a healthy corporate culture, which is the ultimate driver of sustainable financial results. The financial connection is clear. Candor builds trust. Trust creates a stable shareholder base. That stability enables long-term thinking. And long-term thinking is the only path to creating extraordinary and sustainable shareholder value. By investing only in leaders who adhere to this cult of candor, you are systematically tilting the odds of achieving superior capital gains in your favor. The fourth pillar is perhaps the most difficult to practice in a world obsessed with immediacy, yet it is one of the most powerful competitive advantages a business and its investors can possess. It is the principle of a long-term time horizon as a competitive advantage. The greatest leaders in business history are not playing the same game as their competitors or Wall Street. They are not focused on winning the next quarter. They are focused on dominating the next decade. They are planting oak trees in a world where everyone else is trading pumpkins. The quintessential modern example of this principle is Jeff Bezos and the creation of Amazon. From the company's very inception, Bezos was radically transparent about his long-term focus. In his first letter to shareholders in 1997, a document that has become a touchstone for entrepreneurs and investors, he laid out his philosophy with crystal clarity. He wrote, "We believe that a fundamental measure of our success will be the shareholder value we create over the long term." He went on to say, "We will make decisions and weigh trade-offs differently than some companies. We will continue to make investment decisions in light of long-term market leadership considerations rather than short-term profitability considerations or short-term Wall Street reactions." This wasn't just rhetoric, it was the company's guiding operational ethos. For years, Amazon reported tiny profits or even losses, much to the frustration of Wall Street analysts. The stock was incredibly volatile. Pundits constantly predicted its demise, arguing that it was a quote, 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 A's, quote, 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 quote. But Bezos was ignoring them. He was taking every dollar the company generated and plowing it back into building an unassailable infrastructure for the future. He built a network of massive fulfillment centers that allowed for unprecedented delivery speeds. He invested billions in developing Amazon Web Services, AWS, a cloud computing platform that, at the time, seemed completely unrelated to its core retail business. He poured money into the Kindle, into Prime, into Alexa. Each of these was a massive long-term bet that would not pay off for years. A typical, extrinsically motivated CEO, terrified of missing a quarterly earnings target, would never have been able to make these decisions. They would have been forced by the market to deliver short-term profits. But Bezos was an operator obsessed with a long-term vision, to build the world's most customer-centric company. He understood that the best way to serve his shareholders in the long run was to relentlessly focus on serving his customers today, even if it meant sacrificing short-term profitability. The result is now a matter of history. The profitless company became one of the most profitable and valuable companies in the world. AWS, the crazy side bet, became the company's profit engine. The fulfillment centers created a logistical moat that competitors still struggle to overcome. The long-term investments paid off on a scale that almost no one could have imagined. Jeff Bezos demonstrated that a long-term time horizon is not a passive strategy. It is an active, offensive weapon. It allows a company to make investments that its short-term focused competitors are simply unable to make, creating a competitive advantage that, over time, becomes insurmountable. The powerful psychological bias that makes long-term thinking so difficult, yet so profitable, is known as hyperbolic discounting. This is a well-documented tendency in behavioral economics where our brains are wired to prefer smaller, immediate rewards over larger, later rewards. If I offer you a choice between $100 today or $110 in a week, most people will take the $100 today, even though the one-week return is an absurd 10%. We are hardwired for instant gratification. The entire ecosystem of modern financial markets is designed to exploit and amplify this bias. The constant stream of real-time stock quotes, the 24/7 financial news cycle, and, most importantly, the tyranny of the quarterly earnings report all force an intense focus on the immediate present. A CEO's performance is judged not over a 5-year period, but over the next 90 days. Their bonus, their job security, and their reputation are all on the line every single quarter. This creates immense pressure to do whatever it takes to meet or beat the short-term expectations of Wall Street analysts. This is the corporate equivalent of taking the $100 today. The CEO who cuts the R&D budget to make the quarter is sacrificing a potential $1,000 future breakthrough for a few extra pennies of earnings now. The CEO who squeezes their suppliers to boost margins is risking a crucial long-term partnership for a short-term gain. The CEO who underinvests in employee training is saving money today at the cost of having a less skilled and less motivated workforce tomorrow. These are all examples of hyperbolic discounting in action. A truly great leader, a leader capable of building generational wealth, has the rare psychological discipline to override this innate human tendency. They are able to delay gratification on a corporate scale. They have a clear vision of what the larger, later reward will be: a dominant market position, a beloved brand, a technological breakthrough, and they are willing to endure the short-term pain and criticism to achieve it. This psychological fortitude is incredibly rare. It requires a leader who is more concerned with their company's position in 10 years than with their stock price tomorrow. It requires a leader who is, in a sense, an investor themselves, willing to plant a seed and wait patiently for it to grow into a mighty oak, ignoring the chorus of voices demanding they chop it down for firewood today. As an investor, aligning yourself with these rare leaders is a way of outsourcing this psychological discipline. By partnering with them, you are leveraging their ability to resist hyperbolic discounting, allowing your capital to compound at a superior rate over the long term. How can you, as an outside investor, diagnose whether a company's leadership is truly operating with a long-term time horizon? You need a practical method for detecting the signals of long-term thinking amidst the noise of short-term market chatter. This is the quarterly call countersignal blueprint. The quarterly earnings call is typically a theater for short-termism, but for a prepared analyst, it can be a rich source of data on management's true time horizon if you know what to listen for. Step 1. Analyze the response to adversity. Listen for what happens when the company reports a number that misses Wall Street's expectations. For example, a temporary dip in a key metric like user growth or same-store sales. Does the CEO become defensive, make excuses, and immediately promise a quick fix? This is a sign of short-term panic. The countersignal, the sign of a long-term thinker, is a CEO who remains calm and confident. They will acknowledge the short-term dip, but immediately place it in the context of their long-term strategy. They might say, yes, sales were down this quarter because we made a significant investment in a new technology platform that we believe will triple our market share over the next 5 years. This is a short-term cost for a massive long-term gain. They don't manage the emotion of the market, they educate it. Step 2. Track the language of investment. Pay close attention to how the CEO talks about spending. A short-term thinker will talk about cost-cutting, efficiency, and margin improvement. A long-term thinker will talk about investment. They will speak with genuine excitement about spending on research and development, on building a new factory, on a major marketing campaign to build the brand, or on improving the customer experience. They frame these expenditures not as a drag on current profits, but as the necessary fuel for future growth. Count the number of times the word investment is used in a positive, forward-looking context. Step 3. Scrutinize the executive compensation structure. This is where the rubber meets the road. You can find this information in the company's annual proxy statement. Is the CEO's bonus tied to the earnings per share for the next quarter? Or is it tied to the company's return on invested capital over a rolling 3-year or 5-year period? Are stock options granted with short vesting periods, encouraging a quick flip, or do they vest over many years, encouraging long-term ownership? The compensation plan is the most honest statement of the board's priorities. If the incentives are short-term, you will get short-term behavior, regardless of what the CEO says on the conference call. Look for compensation plans that explicitly reward long-term value creation. By using this blueprint, you can turn the quarterly earnings call from a source of anxiety into a powerful intelligence-gathering tool. You can learn to identify the leaders who are simply managing the next 90 days versus those who are methodically building an empire for the next decade. To fully grasp the immense value of a long-term time horizon, we must examine the devastating consequences of its opposite. The path of the 99% is to reward and invest in companies that demonstrate smooth, predictable, short-term growth, even if that growth is built on a rotten foundation. The tragic story of the Wells Fargo account fraud scandal is a stark testament to the dangers of this path. For years, Wells Fargo was the darling of the banking world. It was seen as a model of consistency and profitability, a safe haven in a volatile industry. Its stock was a core holding for conservative investors, including, for a time, Berkshire Hathaway. The company's success was attributed to its brilliant cross-selling strategy. The internal mantra, driven relentlessly from the top, was 8 is great, meaning the goal was to have every customer open 8 different accounts with the bank. This single, simple metric became the obsessive focus of the entire organization. Branch managers were judged on it. Tellers, bonuses were tied to it. The pressure to hit the 8 is great target was immense and unrelenting. What did this intense short-term pressure create? A culture of rampant fraud. To meet their impossible sales quotas and keep their jobs, thousands of employees resorted to secretly opening millions of unauthorized checking and credit card accounts in their customers' names. They would forge signatures, move money between accounts without permission, and create fake email addresses to enroll customers in online services. This was not the work of a few rogue employees. It was a systemic breakdown driven by a leadership team that was pathologically focused on a single, short-term metric that looked good to Wall Street. The leadership, including CEO John Stumpf, either willfully ignored the widespread misconduct or was criminally negligent in their oversight. They had created a pressure cooker environment where the only thing that mattered was hitting the number, every single day, every single week, every single quarter. For a long time, the strategy worked from a stock price perspective. The market loved the steady growth in accounts and rewarded the stock with a premium valuation, but it was a complete illusion. The company wasn't building a healthy, customer-focused business. It was destroying decades of brand trust for the sake of a few extra basis points of quarterly growth. In 2016, the scandal exploded into public view. The company was hit with billions of dollars in fines. The CEO was forced to resign in disgrace. The bank's reputation was shattered, and it lost the trust of a generation of customers. The stock price suffered immensely, underperforming its peers for years to come. The Wells Fargo scandal is a brutal lesson. It shows that when a short-term goal becomes a corporate obsession, it will inevitably lead to value-destroying behavior. The leaders were not focused on building the best bank. They were focused on producing the best number. Investors who cheered them on were mistaking the map for the territory, the metric for the reality. This is the danger of investing without considering the time horizon and cultural incentives set by corporate governance, a mistake that can lead to catastrophic losses in your portfolio. The direct financial connection between a long-term time horizon and superior investment returns is perhaps the most crucial concept for any investor to grasp. It is the very source of what Buffett calls a durable competitive advantage, or a moat. A moat is a structural feature of a business that protects it from competitors, allowing it to earn high returns on capital for many years. Moats are not built overnight. They are the result of years, or even decades, of consistent, long-term investment. Consider some of the most powerful moats. A beloved brand like Coca-Cola or Apple is built over generations through consistent product quality and billions of dollars in advertising. A low-cost production advantage, like that of Geico or Costco, is created through years of painstaking operational focus and a willingness to pass savings on to the customer. A network effect, like that of Facebook or Visa, requires a company to tolerate years of low profitability to build a massive user base that eventually becomes an impenetrable barrier to entry. A company that is managed with a 90-day time horizon is utterly incapable of building any of these moats. A CEO who is terrified of missing a quarterly earnings estimate will never approve the massive, multi-year R&D project needed to create a game-changing new product. They will never agree to lower prices today to build customer loyalty and gain market share tomorrow. They will never make the huge capital expenditures required to build the most efficient factory or distribution network. They are in a defensive crouch, managing the present, while their long-term focused competitor is on the offense, aggressively investing to own the future. This is the financial core of the argument. A wide moat is what allows a company to generate the supernormal profits and predictable cash flows that lead to massive portfolio growth for its shareholders. Without a moat, a business is at the mercy of competition, and its profits will eventually be competed away. Since moats can only be built over long periods of time, a management team's time horizon is a direct predictor of their ability to create a truly great moat-protected business. When you invest in a company led by a long-term thinker like Jeff Bezos, you are investing in a business that is constantly getting stronger, its moat constantly getting wider and deeper. When you invest in a company led by a short-term focused CEO, you are often investing in a business whose competitive position is steadily eroding, even if the current quarter's numbers look good. The financial transformation comes from learning to see the invisible asset being built on the balance sheet, the moat. It doesn't show up in the standard accounting, but it is the single most valuable asset a company can possess. And it is the exclusive product of a leadership team with the vision and courage to play the long game. This brings us to our fifth and final pillar, the one that ties all the others together and ensures the system works for you, the shareholder. It is the principle of skin in the game, the alignment of interests. It is not enough for a CEO to be a passionate operator, a brilliant capital allocator, candid, and a long-term thinker. If their personal financial incentives are not directly and powerfully aligned with the long-term success of the shareholders, the entire structure can fall apart. The simplest way to achieve this alignment is for the leaders to eat their own cooking, for them to have a significant portion of their own net worth invested right alongside the people they are working for. No one embodies this principle more purely than Warren Buffett himself at Berkshire Hathaway. Buffett's compensation arrangement is a model of shareholder alignment. For decades, his annual salary has been a mere $100,000, with no bonuses and no stock options. This is a rounding error for a man of his wealth. The vast, overwhelming majority of his fortune, more than 99% of it, is in the form of Berkshire Hathaway stock. The only way Warren Buffett gets richer is if his shareholders get richer. His financial fate is inextricably linked to theirs. When he makes a brilliant investment decision, his wealth grows in direct proportion to that of a person who owns just a single share. When he makes a mistake, like the Dexter shoe acquisition, he feels the pain in his own net worth far more than any other shareholder. This is the ultimate form of accountability. It ensures that when he sits down to make a capital allocation decision, he is thinking as an owner, because he's the principal owner. He is not thinking about how a decision will affect his year-end bonus or the vesting of his stock options. He is thinking about how it will affect the long-term per-share intrinsic value of the business that represents his family's entire fortune. This owner mindset changes everything. Contrast this with the typical CEO compensation package. Often, a CEO will have a multi-million-dollar salary, a large cash bonus tied to short-term metrics, and a massive grant of stock options. Stock options are particularly problematic. They are a one-way bet. If the stock goes up, the CEO makes a fortune. If the stock goes down, the options are worthless, but the CEO has lost none of their own capital. This creates an incentive to take excessive risks. A big, risky acquisition that might pay off handsomely or might bankrupt the company can look very attractive to a CEO with a lot of options. They have all of the upside and none of the downside. The actual shareholders, however, have all of the downside. This is a fundamental misalignment of interests. A leader with skin in the game, who has purchased a significant amount of stock with their own money, thinks very differently. They are concerned with protecting the downside because their own capital is at risk. This leads to a more conservative, rational, and value-oriented approach to running the business and making acquisitions. The ideal situation, the one you should constantly be searching for, is a company run by a founder CEO or a management team that has a substantial multi-generational ownership stake in the business. They think in terms of decades, not quarters, because they are building wealth for their own children and grandchildren. Their interests are not just aligned with yours, they are identical. The core psychological and economic principle at play here is known as the principal-agent problem. It's one of the most fundamental concepts in all of business and finance. The principal, in this case, the company's shareholders, hires an agent, the CEO, to act on their behalf and manage the business. The problem arises because the agent often has different goals and incentives than the principal. The agent may be more interested in maximizing their own personal compensation, prestige, and power than in maximizing the long-term value of the principal's investment. This divergence of interests can lead to a host of value-destroying behaviors. For example, the agent, the CEO, might use company funds to purchase lavish corporate jets or sponsor glamorous sporting events. These perks enhance the CEO's lifestyle and ego but do nothing for the owners of the business. The CEO might pursue a foolish, empire-building acquisition simply because running a larger company is more prestigious and comes with a bigger paycheck, even if the deal destroys shareholder value. The CEO might fight tooth and nail against a takeover offer that would be highly profitable for shareholders, simply because it would mean they would lose their job. The entire field of corporate governance is an attempt to solve this principal-agent problem, to create systems and structures that force the agent to act in the best interests of the principal. Executive compensation plans, the board of directors, and shareholder voting rights are all tools designed to mitigate this conflict. But the single most powerful solution, the one that cuts through all the complexity, is skin in the game. When the agent is also a major principal, when the CEO is one of the largest individual shareholders, the problem largely evaporates. The agent's self-interest becomes aligned with the principal's self-interest. They want the stock to go up for the same reason you do, because they own a lot of it. They are frugal with corporate expenses, because, in a very real sense, it's their money being spent. They are skeptical of dilutive stock option plans because it's their own ownership stake that is being diluted. The principal-agent problem explains why so many seemingly smart CEOs make such poor decisions. Their actions may seem irrational from a shareholder's perspective, but they are often perfectly rational when viewed through the lens of the CEO's personal incentives. By focusing your investments on companies where this conflict is minimized, where management thinks and acts like owners because they are owners, you are sidestepping one of the most pervasive and destructive forces in the corporate world. You are ensuring that the person flying the plane has as much or more to lose than the passengers. To systematically identify companies where management's interests are truly aligned with your own, you need to learn how to read the least read but arguably most important corporate document, the proxy statement, also known as the DEF 14A. This is the document sent to shareholders before the annual meeting, and it contains a treasure trove of information about governance and compensation. Here is your proxy statement deep dive blueprint. Step 1. Go straight to the CEO compensation table. This will lay out the CEO's salary, bonus, stock awards, and option awards for the past few years. Don't just look at the total number. Analyze the structure. How much of the pay is fixed, salary versus variable and at risk, bonus and equity. A high fixed salary insulates a CEO from poor performance. You want to see a structure that is heavily weighted toward long-term incentives. Is the bonus tied to sensible long-term business metrics like return on capital, or is it tied to vague personal goals or short-term metrics like adjusted earnings per share? Step 2. Find the insider ownership table. This is the most important part of the proxy. It will list the number of shares owned by the CEO, the other top executives, and the members of the board of directors. The key question here is the ownership meaningful? A CEO of a multi-billion-dollar company who owns a few $1,000,000 worth of stock may sound like a lot, but it might be a tiny fraction of their net worth. You are looking for situations where the value of the executive's stock holdings is a very large multiple of their annual salary. Even more importantly, you want to see if they have been buying stock in the open market with their own money, rather than just receiving it through grants. Open market purchases are the most powerful signal of true belief in the company's future prospects. Step 3. Compare stock buybacks to stock issuance. In the main annual report, the 10K, you can find information on how much stock the company has repurchased. In the proxy, you can see how much stock has been issued to executives and employees through option plans. A common Wall Street trick is for a company to announce a large stock buyback program, which investors cheer, while simultaneously issuing a similar amount of new stock to insiders. The net effect is that the buyback does nothing to reduce the overall share count and simply serves to enrich management without diluting them. A truly shareholder-friendly company will have a buyback program that results in a significant and sustained reduction in the number of shares outstanding over time. This makes your slice of the pie bigger. By conducting this deep dive on every potential investment, you move beyond the surface-level narratives and get to the hard facts of alignment. You will be able to clearly distinguish between the hired gun manager, whose incentives may be questionable, and the true owner-operator, whose financial success is directly tied to your own. The tragic story of the final years of Sears under the leadership of hedge fund manager Eddie Lampert serves as the ultimate antithesis of the skin-in-the-game principle, but in a very deceptive way. On the surface, Lampert seemed to have perfect alignment. He was the CEO, the chairman, and through his hedge fund, the company's largest shareholder and creditor. He had more skin in the game than almost any CEO in America. But this story reveals a crucial nuance. It's not just about Morse's a leader has skin in the game, but Morse's bear game is being played. Lampert was not a retailer. He was a brilliant financial engineer. He took control of Sears and Kmart with a vision of turning these aging retailers into a lean, data-driven enterprise. However, his approach was not that of an owner-operator focused on reviving the core business. It was that of a financier focused on extracting value from a declining asset. Instead of investing capital to refresh the tired, dilapidated stores, he starved them of it. The stores became depressing, empty shells of their former selves. He broke the company up into dozens of internal business units, appliances, apparel, auto centers, and forced them to compete against each other for resources, creating a toxic and dysfunctional internal culture. While the core retail business was crumbling, Lampert engaged in years of complex financial maneuvering. He spun off valuable assets like Land's End and Sears hometown and outlet stores. He created a real estate investment trust, Seritage Growth Properties, and had Sears sell hundreds of its best properties to it, locking the retailer into expensive lease agreements. These moves were often profitable for Lampert's hedge fund, which participated in these spin-offs and owned a large stake in Seritage. But they bled the main Sears operating company dry. His skin was in the game, but his game was not to save Sears the retailer. His game, it appeared to many observers, was to slowly liquidate the company for the benefit of his hedge fund. He was both the agent and the principal, but his interests as a hedge fund manager, the principal, were in conflict with the interests of the other shareholders of Sears stock. The company eventually collapsed into bankruptcy, destroying what was left of the common shareholders' equity. The Sears saga is a powerful and subtle cautionary tale. It shows that even massive insider ownership can be a red flag if the leader is a financial engineer, not a business operator. Their goal may not be to nurture the business for long-term growth, but to strip its assets for short-term financial gain. True alignment exists when a passionate operator who loves the business also has a massive, long-term ownership stake. When you have a financial engineer with a controlling stake, you may have just handed them the keys to dismantle the company for their own benefit, leaving minority shareholders with an empty shell. The direct financial connection of having true skin in the game is the most powerful and reliable predictor of long-term investment success. The impact on the company's financials and your portfolio growth is profound and multifaceted. When management thinks like owners because they are owners, a culture of frugality takes root. They are less likely to spend lavishly on corporate headquarters, private jets, or other perks that don't add to the bottom line. This operational leanness translates directly into higher operating margins and better profitability. Every dollar not wasted on corporate ego is a dollar that can be used to strengthen the business or be returned to shareholders. Second, owner-operators are far better capital allocators. When it's their own money on the line, they are intensely focused on the return they will get from any investment. They are less likely to overpay for a hot acquisition or pour money into speculative low-return projects. This disciplined approach to capital allocation leads to a consistently higher return on invested capital, which, as we've seen, is the primary engine of long-term intrinsic value growth. Third, companies with high insider ownership tend to use debt more prudently. A hired gun CEO might leverage the company to the hilt to finance a risky bet, knowing they can walk away with a golden parachute if it fails. An owner-operator whose family fortune is tied to the company's survival is deeply averse to taking on excessive risk. This results in a stronger, more resilient balance sheet that can weather economic storms and seize opportunities when competitors are forced to retreat. The cumulative effect of these behaviors is staggering. Numerous academic studies have demonstrated a strong positive correlation between significant insider ownership and long-term, market-beating stock performance. It is one of the most persistent and powerful anomalies in the financial markets. By systematically screening for and investing in companies led by owner-operators, you are not just buying a stock. You are entering into a partnership with a team whose interests are hardwired to be aligned with yours. You are tilting the odds dramatically in your favor. This strategy moves you away from the realm of speculation and into the world of business-like investing. It is the final, crucial piece of the puzzle, the governor on the engine that ensures all the other positive attributes, operational focus, candor, long-term thinking, are channeled directly toward the goal of creating sustainable, long-term shareholder value and securing your financial freedom. You have just spent this time acquiring a powerful new lens, a piece of mental software that allows you to look past the flickering numbers on a screen, past the confident pronouncements of well-rehearsed executives, and see the true heart of a business. You now understand that the most important question is not what is the stock doing, but what is the management thinking. You can now differentiate between the operator, whose hands are dirty with the details of the business, and the financial engineer, whose hands are clean but whose spreadsheet is king. You have gained a framework to analyze not just the what of a company, but the who and the why. This is an incredible advantage, but it's crucial to understand that what you've just mastered, as powerful as it is one critical piece of a much larger interconnected system. Warren Buffett's approach to investing is not a single trick. It is a complete philosophy, a network of interlocking mental models. Knowing how to identify the right jockey is the first step, but you also need to know how to identify the right horse, the business with a durable competitive advantage. You need to know how to calculate the horse's intrinsic value, so you never pay too much. And you need to know how to demand a margin of safety, a discount to that value that provides protection against the unforeseen. The video that is now appearing on your screen is not an accident, it is the next piece of that map. It is the vital link that connects the who of management with the what of the business itself. It takes the foundation we have built today and builds upon it, showing you how these world-class leaders apply their mindset to the specific characteristics of the businesses they run. Most people will stop here. They'll feel satisfied with this new tool and move on. But you have demonstrated a commitment to go deeper. The decision you make in the next few seconds is not about watching another video. It is a choice about your identity as an investor. Will you remain a collector of interesting ideas, or will you continue the disciplined work of assembling the complete mental arsenal required for true financial sovereignty? The next step in your journey is right there. The choice is yours. Click and continue your ascent.